Most traders don't lose money because of bad stocks, they lose because of bad psychology. Think about that. Two people can buy the exact same stock on the exact same day at the exact same price, and yet one walks away with a 20% gain while the other walks away with a 30% loss. How can that happen? It isn't the stock, it isn't the market, it's the brain. Your brain plays tricks on you the moment money's on the line. It whispers, hold on just a little longer. It'll bounce back. Or, this time is different, the rules don't apply. It rewards your ego for breaking discipline, even though that choice digs you deeper into danger. And here's the uncomfortable truth. Every time you break a rule to protect your pride, you're not just risking dollars, you're training your brain to sabotage you again. You're rewiring your psychology, your tolerance for risk, your patience, even your identity as a trader. That's why two traders with the same information can live two completely different outcomes. One trades the market. The other trades their emotions. Now, here's the good news. Those sabotaging patterns aren't permanent. They can be interrupted, rewritten, and replaced. That's what this video is about. I'm going to show you the psychology behind why so many traders self-destruct and the rules that can break the cycle. Rules taken from one of the most practical, tested, and actionable trading books ever written. But before we dive into the system, let me hook you with a smaller idea, one you can hold in your head right now. Here's the irony. The more you try to outsmart the market with raw instinct, the more the market punishes you. The more you think you're in control, the less control you actually have. Discipline feels restrictive at first, but it's the only true freedom you'll ever have as a trader. Stick with me. Because if you understand the psychology behind these rules, you'll never look at the market or your own decisions the same way again. Here's a paradox I've learned the hard way. The market punishes improvisers and rewards planners. The more you lean on gut feeling, the more likely you are to get chewed up. But when you anchor yourself in rules, routines, and psychology, you create freedom. You free yourself from second guessing, from panic, from the trap of chasing every headline. And that's what this channel is built for. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. Most traders don't stop to ask a simple question: where do these rules even come from? They assume every trading strategy is just someone's opinion, a theory cooked up to sound convincing. But the rules I'm sharing with you today aren't guesses. They come from a book that's been tested, refined, and put into practice by thousands of traders over the years. It's called How to Make Money in Stocks Getting Started, a guide to putting slim concepts into action by Matthew Galgani. That's the one and only time I'll use the full title. From here on, I'll just say the book or Galgani. Now, here's why this book stands out. It's not written in a vacuum. Galgani worked directly with William J. O'Neill, the legendary investor who created the Slim system and wrote the classic How to Make Money in Stocks. O'Neill's book is dense, brilliant, but intimidating for beginners. Galgani's version is the approachable guide. It takes O'Neill's framework, keeps the heart of it intact, and makes it digestible, actionable, and easier to apply from day one. When I first read it, what struck me wasn't just the system, though the rules were powerful on their own. What really grabbed me was how much of it was about psychology, about protecting yourself from your own worst impulses, about building systems and routines that strip emotion out of the process, so discipline becomes automatic. And that's what made it stick. Because once I saw how these rules lined up with the exact traps I'd seen traders fall into again and again, it clicked. This isn't just a trading method, it's a survival framework. Which is why I want to take you inside one of my own stories, a moment when I ignored every rule and paid the price. Here's the funny thing about trading: when people tell me their biggest regrets, it's rarely about missing a winning stock. It's almost always about the times they knew what the rule was and broke it anyway. I know that regret personally. Early in my trading journey, I had one of those setups that felt like a gift. The chart was clean, the volume was strong, the fundamentals looked great. I convinced myself this was the kind of stock that could only go higher. I told friends about it. I even imagined how smart I'd look when it doubled. But then the market did what markets do. It dipped. Just a little at first. A red candle on the chart. Nothing unusual. I told myself, it'll bounce. It's just shaking out the weak hands. The next day, the dip got deeper. Now I was down 5%. I thought, I can't sell now. That would be too early. I'll look stupid locking in a loss when I know it's about to turn. The following week, it wasn't a dip anymore. It was a slide. Down 10%. Down 12%. My stop loss should have triggered at 7 or 8%. But I ignored it. I didn't want to feel the sting of being wrong. I wanted to protect my ego more than my account. And that's how a tiny scratch turned into a wound. I ended up losing over 40% on that trade before I finally threw in the towel. Here's the kicker. If I had followed the rules from the book, cut losses at 7 to 8%, that loss would have been a paper cut. Annoying, but survivable. Instead, it became a scar that stuck with me for months. That was the first time I really saw it clearly. The market didn't beat me. My ego did. The market just exposed it. And if you've ever been there, you know the pain isn't just financial, it's psychological. You start second-guessing yourself. You hesitate on the next setup. You wonder if you're even cut out for this game. That trade was my wake-up call. It forced me to confront something I didn't want to admit. I wasn't losing because of bad stocks. I was losing because I didn't have the discipline to follow my own rules. But here's the beautiful part. Once you recognize that, you can change it. You can build systems that protect you from yourself. You can replace ego with process. And when you do, trading starts to feel different. Less like gambling, more like craftsmanship. That's why I connected so deeply with Galgani's book. It wasn't telling me anything mystical or secret. It was reminding me that survival in the market is about structure, not brilliance. It was about anchoring myself to a framework that made the right decision easier to follow than the wrong one. And that's what I want to show you in this video. Not just a list of rules, but the psychology that makes them necessary. Because this isn't about chasing hot tips or guessing tomorrow's winner. It's about something more valuable, survival psychology. Knowing when to buy, when to sell, and most importantly, how to protect yourself from yourself. So let's zoom out for a second. Let's look at the bigger picture that ties all of this together. Most people step into the market thinking the challenge is finding the right stock. But here's the twist. The real challenge isn't picking stocks. It's holding yourself together once you're in the trade. That's why I want to set expectations clearly. This conversation isn't about guarantees. It's not about some magic shortcut to riches or a can't-miss stock pick. If you came looking for that, this probably isn't the video for you. What we're going to talk about is survival psychology. How to spot the moments when your brain is trying to trick you. How to build routines that give you calm in the middle of chaos. And how to follow a few simple rules that protect your capital when emotions try to take it from you. This is education, not financial advice. I'm sharing what's worked for me and what Galgani's book lays out, but every decision in the market carries risk. You're the one in charge of your account. If you understand that, then you're ready for the shift that separates gamblers from survivors. Here's the image I want you to keep in your head for the rest of this talk. Trading is like sailing through storms. You don't control the waves. You don't control the wind. You don't even control when the storm decides to roll in. All you control is your ship, how it's built, how it's steered, and whether it's prepared for what's coming. Most traders sink because they spend all their energy yelling at the storm instead of reinforcing their ship. They argue with the weather, they cling to hope, and they forget the ocean doesn't care. But here's the shift. When you design your ship with rules, discipline, and structure, storms don't scare you anymore. You may not enjoy them, but you know you can survive them. That's what this framework is, a design for your ship. And it starts with 4 lessons. Here's a thought experiment. Imagine you found the perfect stock. Strong earnings, huge growth story, everyone's talking about it. You buy in with confidence. But then the overall market starts sliding. Suddenly, your perfect stock isn't moving on its own story anymore. It's being dragged down with everything else. That's lesson 1. The market dictates everything. Matthew Galgani puts it bluntly in the book, 3 out of 4 stocks follow the general market trend. If the tide is going out, even the strongest swimmer gets pulled back. I've seen this play out with so many traders I've worked with. They'll cling to a stock because the fundamentals look great, or because they're emotionally attached to the company. But when the broader market is in correction, they're fighting a current that's too strong to beat. They mistake conviction for control. And this is where psychology comes in. It's the illusion of control. We love to believe our stock will be the exception, that somehow the market rules don't apply if we've picked the right company. But history shows otherwise. Look back at the 2022 bear market. You could have owned the best tech names in the world: Apple, Microsoft, Nvidia. These weren't junk companies, they were world leaders. And yet when the market corrected, they all took heavy losses right along with everything else. The data is clear. Studies on correlation show that during major corrections, the relationship between individual stocks and the overall market spikes dramatically, often above 80%. In other words, in rough markets, your stock isn't trading on its story, it's trading on the market's fear. The takeaway is simple but hard to practice. You don't have to be invested all the time. In fact, one of the biggest edges you can give yourself is the discipline to sit on your hands when conditions aren't right. The amateurs force trades in any weather. The pros know when to stay in port. I had to learn this the hard way too. Years ago, I got attached to a company I thought couldn't lose. The fundamentals were off the charts. The story was irresistible. I held on even as the market slipped into correction. At first, the loss was manageable. Then, it snowballed. By the time I admitted the truth, I'd watched a winning trade unravel into a gut punch. That's when it clicked. The market doesn't care how much I believe in a stock. The tide pulls on everything. And my job isn't to fight the tide, it's to read it. So here's the question for you. Are you trading your stock? Or are you trading the market's direction? Because if you can't answer that, you're already at risk of swimming against a current you can't see. Think about the last time you held onto a trade, just a little too long. You saw the red creeping deeper on your screen, but you told yourself, it'll come back. Just give it one more day. That's the most expensive phrase in trading. Lesson 2 is ruthless but clear. Cut losses without mercy. The book lays it out with no wiggle room. If a stock drops 7 to 8% below your entry, sell it. No questions, no bargaining. No what-ifs, just cut. Here's a real example. Remember when Snapchat went public in 2017? It was one of the most hyped IPOs of the decade. Everyone from college students to professional traders piled in, convinced this was the next Facebook. The stock opened at 24 and quickly surged above 29 in its first days. It felt unstoppable. But then reality hit. Within weeks, Snapchat slipped below its IPO price. At first, it was just a minor dip, a couple of points. Traders told themselves, it's just post-IPO volatility, it'll recover. But the slide kept going. 22, 2018, $18. By the end of its first year, Snapchat was down more than 40% from its highs. The traders who followed a strict stop-loss rule took a small, controlled hit. The ones who refused to cut, who kept saying, it'll come back, got trapped. Some held all the way down to 12, nursing losses of 50% or more. And this is where psychology stings the hardest. Behavioral finance research by Kahneman and Tversky showed that losses feel about 2.5 times more painful than gains feel rewarding. That's loss aversion. It convinces you that admitting a 7% mistake is unbearable, so you risk a 50% collapse instead. I've been there myself. Early in my career, I let a loser bleed way past my stop. I rationalized, told myself stories, convinced myself I was smarter than the crowd. The result? A 40% drawdown on a single trade that should have been nothing more than a scratch. And here's the hidden cost: opportunity. Every dollar locked in Snapchat at 20, 18, 15 was a dollar that couldn't flow into the true leaders of that market cycle, like Nvidia or Amazon. The stubbornness didn't just lose money. It cost months of progress. That's why the best investors treat small losses as tuition. They respect the stop. They don't argue with the market. They don't let their pride drain their account. A small loss is a paper cut. Annoying, yes, but harmless if handled quickly. Ignore it, and it festers into an infection that threatens your entire account. So let me ask you, do you want to be right, or do you want to survive? Because survival is the only thing that keeps you in the game long enough to catch the real winners. And that survival mindset leads directly into the next trap, the danger of falling in love with a winner. One of the sneakiest traps in trading is falling in love with a winner. You buy a stock, it starts running higher. Your confidence soars. You feel like you've finally cracked the code. Instead of following your plan, you start telling yourself a story. This one's different. This one's going to the moon. I'll just hold a little longer. That's when the market usually humbles you. Lesson 3 is clear: ride winners, but don't marry them. The book makes it simple. Take most profits when you're up 20 to 25%. If a stock rockets 20% in 3 weeks or less, you can give it a longer hold, around 8 weeks. But beyond that, discipline has to override hope. We saw this play out in real time with Peloton. In 2020, as the world shut down, Peloton became the golden child of the stay-at-home trade. The stock soared from under $30 in March to over $160 by the end of the year. People who bought early felt like geniuses. Some cashed out discipline gains along the way, 25% here, 40% there, and walked away with life-changing profits. But others fell into the marriage trap. They didn't just own Peloton, they became Peloton. It wasn't a stock anymore, it was an identity. This company is changing the world, they said. I'll never sell. Then came 2021. As the economy reopened, demand cooled and competition stiffened. The stock slid, first to 120, then to 100, then to 80. By early 2022, Peloton had collapsed below $20. Traders who refused to sell had given back nearly everything. What was once a career-making trade turned into a brutal round trip. That's not just a financial mistake, it's psychological. Research by Barber and Odean on thousands of retail traders found the same pattern again and again. People sell their winners too early and hold their losers too long. Why? Ego, identity, and fear of regret. Selling a winner too soon feels like leaving money on the table, but refusing to sell feels like strength, even when it's really denial. I've seen it firsthand in traders I've coached. One friend rode Peloton up more than 100% in 2020. Instead of banking profits, he convinced himself it was only the beginning. He told me, I can't sell now. What if it doubles again? By the time he finally let go, he'd given back nearly all of it. Not because the stock betrayed him, but because he betrayed his own rules. Here's the truth. Stocks don't care about you. They don't care about your story, your ego, or how much you believed in them. They're not your trophies. They're tools. And tools only serve you when you use them with discipline. So here's the shift to make. Ride your winners, but do it with structure. Set profit targets. Respect them. Take money off the table while the market is still giving it to you. Don't fall for the illusion that every rally is eternal, because the traders who survive aren't the ones who find the next big thing. They're the ones who lock in gains and move on. And the only way to keep that humility in check is to build routines that keep you grounded. Which brings us to the final lesson. Here's a truth that doesn't sound flashy but changes everything. Routines beat emotions. Most traders think they'll just feel when to act. But feelings swing with every tick of the chart, every headline, every rumor. If you rely on them, the market will chew you up. Lesson 4 is about building routines that lock in calm confidence. The book keeps it simple. Do a weekend routine, update your watch list, review the market trend, spot the setups worth tracking. Then, during the week, spend just 10 minutes a day checking your plan and adjusting orders. That's it. Nothing fancy, nothing overwhelming. When I first heard that, I thought it sounded boring, but boring is exactly what saved me. In 2020, when the pandemic triggered one of the fastest crashes in history, I had every reason to panic. Headlines screamed. Twitter was chaos. Stocks were moving in 10% swings overnight. But my routine gave me structure. Instead of doom scrolling, I checked my watch list. I updated my notes. I waited for the market's follow-through day. And when it came, I was ready to buy leaders breaking out with volume, while many traders were still frozen in fear. That's the power of routine. It shields you from emotional noise and keeps you anchored when volatility tries to shake you apart. And psychology backs this up. A study from University College London found it takes about 66 days, on average, to form a habit. After that, the behavior becomes automatic. That means your brain no longer burns energy deciding whether to follow your plan, it just does it. Decision fatigue goes down, discipline goes up. I've seen the flip side too. Traders without routines drift. They chase whatever's moving. They overtrade. They check their phones every 5 minutes because they don't have a scheduled process. Their trading is ruled by moods, not systems. And moods are expensive. So let me ask you, do you want your trading shaped by how you feel in the moment, or by a process you designed in calm clarity? If you build routines, the storms feel less violent. You're not guessing anymore, you're executing. And when the storms pass, you're the one still standing with cash in hand, ready to play the next cycle. That's the essence of calm confidence. It doesn't come from predicting the market. It comes from knowing your plan is stronger than your emotions. And now that you've seen the 4 lessons, let's zoom out. Let's test these rules against real market history, the crashes, the recoveries, and the cycles that prove just how vital psychology and discipline really are. Markets have a way of testing every rule you claim to follow. Take 2009. The financial crisis had just gutted portfolios. Headlines screamed about banks collapsing and unemployment soaring. Fear was everywhere. Yet that was exactly when a new uptrend began. Traders who trusted the signals, who saw the follow-through day and respected the tide, caught leaders like Priceline and Baidu as they launched powerful runs. Those who stayed paralyzed or who clung to broken stocks from 2008 missed the recovery of a lifetime. Fast forward to 2020. In March, the world shut down and stocks plunged at historic speed. Entire indexes dropped more than 30% in weeks. Many traders panicked, dumping everything at the bottom. But those with a routine, updating watch lists, tracking distribution days, waiting for confirmation, were ready when the follow-through day appeared. Companies like Zoom, Nvidia, and Shopify became explosive leaders in the rebound. The same rules that look boring in quiet markets became life-saving in chaos. And then came 2022, a bear market that reminded us once again, the market doesn't care about your hopes. Inflation spiked, the Fed raised rates, and indexes slid for most of the year. Strong companies, Apple, Microsoft, Nvidia, all got dragged down. That's lesson 1 in action. 3 out of 4 stocks follow the market. If you fought the tide, you bled. If you stayed defensive, cut losses quickly, and waited for the storm to pass, you preserved capital for the next cycle. Each of these moments proves the same thing. The rules aren't suggestions. They're survival mechanisms. They're the difference between being forced out of the game and being ready when the next opportunity comes. And here's where psychology sneaks in. In 2009, it was fear of buying too soon that froze traders. In 2020, it was panic at the bottom that triggered mass selling. In 2020, it was denial, the refusal to admit the trend had turned, that trapped people in grinding losses. Different markets. Same traps. This is why discipline matters more than prediction. Nobody saw the exact timing of the 2009 recovery, the 2020 crash and rebound, or the grinding bear of 2022. What separated survivors was never foresight. It was the willingness to respect the tide, cut losers, take profits, and stay grounded in routine. Because when the storm clears, the traders with cash and discipline are the ones left standing. And they're the ones who get to play the next cycle with strength. Which brings us to something most traders hate admitting. Even when the rules are clear, psychology still pulls them into the same mistakes. Here's the cruel part of trading. The traps don't feel like traps when you're falling into them. They feel like common sense. Overconfidence tells you, this stock can't possibly drop any lower. You feel in control, even when you're not. It's the illusion of mastery, mistaking a few good trades for invincibility. I've seen traders double their position size right after a winning streak, only to watch one bad trade wipe out weeks of progress. That's overconfidence cashing its check. Loss aversion whispers, just hold a little longer, it'll come back. You'd rather risk a bigger loss than admit a small mistake. Kahneman and Tversky proved it in their research. The pain of a loss is felt more than twice as strongly as the joy of an equivalent gain. That's why traders will rationalize holding a minus 20% loser, even when the rulebook says cut it at minus 7%. And then there's revenge trading, the urge to get even with the market. I've watched smart traders suffer a loss, then immediately jump into another trade with double the size, desperate to win it back. In their heads, they're fighting. But in reality, they're gambling. One study found traders take significantly riskier bets immediately after losses, as if their biology hijacks their discipline. That's not strategy, that's emotion in disguise. Here's the dangerous part. These traps don't announce themselves. They sneak in through your self-talk, your emotions, even your body language at the screen. They feel like logic in the moment. Only later, when the damage is done, do you recognize them for what they were. The antidote isn't willpower, it's awareness and rules. Rules that you commit to in advance, so when your brain tries to trick you, the decision's already made. That's why the book's principles are so powerful. They're not just about where to buy or sell, they're about creating guardrails that protect you when your psychology wants to drive off a cliff. So the question becomes, what should actually be on your mind before you even take the trade? Before you click buy, pause. Take 10 seconds to ask yourself a few brutal questions. Those 10 seconds could save you months of regret. First, is the market even on your side? Remember, lesson 1, 3 out of 4 stocks follow the general market. If the indexes are in correction, odds are your trade is already fighting a losing battle. You can be right about the company and still lose money if the tide is pulling everything down. Second, does this stock actually earn its spot on your screen? Has it shown accelerating earnings? Strong sales growth? Is it a leader in its sector? Or just a cheap laggard you're hoping will play catch-up? Are institutions quietly buying or quietly leaving? If you can't answer those, you're trading a story, not a stock. Third, what's your exit plan? Not the fantasy version where everything goes perfectly, but the real one. Where will you cut the loss if it turns against you? At 7 or 8%? Where will you take profits before greed convinces you to hold forever? If you can't write those numbers down in advance, you're not trading, you're gambling. And finally, how will you protect your psychology once you're in? Because here's the twist, the second you own shares, your brain changes. You stop seeing the chart objectively and start seeing it as a reflection of yourself. That's when emotions take over. If you don't have a plan for managing that shift, whether it's preset stops, journaling, or a routine check-in, you're already at risk. If you can't answer these questions clearly before you enter, you're trading blind. And the market is brutal to blind traders. So here's my challenge, make these questions part of your routine. Write them down, take them to your desk. Don't give yourself the luxury of skipping them. Because when your mind is clear before the trade, you'll have the strength to stay clear when the storm hits after. And once you've answered honestly, it's time to hold up the mirror. To ask yourself if you're really living by the rules you say you believe in. Be honest with yourself for a moment. Do you really cut losses at 7 or 8%? Or do you let them slide, hoping the market will forgive you? Do you plan your exits before you enter? Or do you improvise when emotions are running high? Do you build watch lists when the market is down? Or do you disappear until the next rally tempts you back in? These aren't just trading questions, they're mirrors. Every answer reveals whether you're building discipline or building habits that sabotage you. Because the truth is, the market doesn't punish ignorance, it punishes avoidance. Every skip routine, every ignored rule, every just this once compounds into a story you don't want to tell. Here's a simple test I give traders I work with. Pull up your last 10 trades. For each one, ask, did I follow my rules or did I follow my feelings? Write it down, count it up. If more than 3 of those trades were driven by emotion, you don't have a market problem, you have a discipline problem. And discipline problems don't fix themselves. They grow quietly until the account balance forces you to pay attention. So let me ask you again. When you look back at your last few trades, were you respecting your process or were you negotiating with your emotions? That reflection isn't comfortable, but it's where change starts. Here's what I want you to do right now. Write down the single biggest lesson you pulled from this talk. Put it in the comments. Not for me, for you. Writing it out makes it real, and it gives you something to come back to the next time emotions start pulling you off course. Then, share this video with a friend you know is struggling in the market. Maybe it's someone who keeps holding losers too long. Maybe it's someone chasing trades out of boredom. You never know, your timing might save them from making the mistake you just avoided. And of course, hit like and subscribe so these lessons keep showing up in your feed when you need them most. Because the market doesn't just test your charts, it tests your psychology. And if you don't have reminders to stay sharp, the old habits creep back in fast. Remember, The market will always test you. It doesn't care about your feelings. It doesn't care about your hopes. But if you prepare your mind the way you prepare your charts, you won't just survive those tests, you'll come out stronger. That's the real edge. Not the hot tip. Not the perfect indicator. It's the discipline to follow rules when your brain begs you not to. So, take a breath. Think about your last trade. And ask yourself, did you protect your account or did you protect your ego? The answer to that question decides the trader you'll become. Master your mind. Master the market. Trade with confidence and live with calm.